this month. Its biggest month has evaporated. So the question now is, will this time be different? Can these gains actually be sustained? A lot of that is going to hinge on the COVID headlines coming out of China.
Kelly Lyons, what a roller coaster it's been. Reopening on, reopening off. Kelly, thank you. And a special thanks to Alan Wan over in Shanghai as well. Fantastic coverage from him over the last couple of days. In the equity market here, stateside, 21 minutes into the session, we are down by just 0.1% on the S&P. On the Nasdaq, a similar move. In the bond market, yields higher. Through the curve, 2s out to 30s, up 4 basis points on a 2-year to 4.48 on a 10-year. We are higher as well by about 6 basis points or so, 3.74 on a 10-year this morning. Let's get you some sector price action. Here's Abby.
With that very small move for the S&P 500, John, not surprisingly, we're not seeing so much drama here sector-wise. The top sector on the day, energy, up about almost 1%. No sector is moving 1% up or down, a true 1%, I should say, as oil does rally. Again, WTI crude, as I was mentioning earlier, close to $80 per barrel. Probably some hope around the idea that China is reopening. We have real estate, materials, financials higher, tech, the mega cap tech sectors, they're all kind of in the middle, down about 0.3%. No big deal as rates rise a little bit. What I do want to hone in on, we were going to do China tech, but Kaylee just did a fantastic job of outlining that rally. Let's take a look at an unusual move here because we have rates higher. Typically, that would press both real estate and utilities down. Today, utilities acting as they should. The dividends looking less attractive as rates go higher, but real estate, it is higher, John. It's not really entirely clear what's behind this, but most of the REITs in that sector are up, and overall that sector up about 0.6%. Highlighting this because we've had so many strange moves on the year. Here's one of them on the day.
Abby, thank you very much. That's the equity breakdown. A little bit earlier this morning I mentioned that Amazon was kicking off a 5-part bond sale, the second bond sale of 2022 from Amazon. Earlier this year, back in April, they sold bonds in a $12.75 billion deal. We understand the target size of this offering is $7 billion. That could change according to a person familiar with the matter. The 10-year security, that would be the longest portion of the offering, may yield 1.15 percentage points over treasuries, again according to a person with knowledge of the matter who asked not to be identified as the details are private. Any more details on this, I'll bring them to you, but some bond sales picking up and treasury yields up off the back of some of this. The 10-year yield higher by 6 basis points, the 2-year up by 4 basis points. Up next, we'll get you the trading diary from New York. This is Bloomberg.
They're stressing the longer rather than the ever higher. So I think once we get to 5.25, 5.5, I think they'll relent, and then they'll just sit there and wait for that restrictive monetary policy to slow the economy down, generate more slack in the labor market, and that will gradually push both wage inflation and services price inflation down.
I've always found that the former Fed officials tell you what they really think and don't hold back in quite the same way as they might have done when they were at the Fed. That was Bill Dudley there, formerly of the New York Fed and now a Bloomberg opinion columnist. Fortunately for us, equity futures were positive through much of this morning. Then we got the opening bell and things rolled over just a little bit. We're down about 0.2% on the S&P 500. On the Nasdaq, we're down by about a third. That's some of the price action. Let's get you the trading diary. Consumer confidence coming up at the top of the hour. President Biden convening with members of Congress at 10:30 Eastern, promoting his economic agenda from Michigan later this afternoon at 3:30. A host of U.S. economic data, including U.S. GDP, core PCE and jobs data coming up tomorrow. Plus, we'll hear from Chairman Powell alongside Governors Bauman and Cook. Another round of U.S. jobless claims coming out on Thursday. And finally, closing out the week with payrolls Friday and the estimate in our survey, something in and around 200K. From New York, this is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on Tuesday, November 29th. Here are the top market stories that we're following for you at this hour. You got Fed hawks versus some dollar bears. Fed officials make it very clear more hikes are coming and staying for longer, but the dollar bear yawn and carry on. Calvaria's 2023 pick. We're going to speak to Wall Street veteran Leon Calvaria, chairman of Citi's Institutional Clients Group, to get his take on bankers, bonuses, and his predictions for next year. And consumer crushed or cracks. I finally stopped shopping. Maybe. We get the latest read on the consumer with Dana Peterson of the Conference Board as the data drops right now. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. I'm a healthy consumer, but I'm done now. What does the data tell you?
Are you really done? Honestly, I thought you were done yesterday, but no, the shopping continues.
Just one. One deal. It was really cheap steak knives, but I'm done. I'm really done this time.
Okay. We'll see. I'll believe that when I actually see it, when those last-minute deals come flooding through. Apparently, Cyber Monday was pretty strong. I think we need to bear that in mind when we look at the data that is dropping onto the screens in front of us right now, because the Conference Board consumer confidence numbers come out a little softer than last time, but pretty much in line at a headline level in terms of expectations. The headline number comes through at 100.2, down from 102.5. The expectation was 100. It's the forward-looking indicators that I think are worth paying attention to. The present situation, 137.4 versus 138.9, which has been revised lower to 138.7. But it's the expectations one that I'm looking at, because this is where, Alex, we get a good read on what is happening with the recession that everybody's pricing in for next year. 78.1 the last number, 75.4 the previous number revised a little lower. That's where you want to pay attention. That's where the recession indicator might be coming from.
Yep, and I think that this also tracks with my shopping experience, right? Like strategic shopping. Like, you're not just going to go out there and feel good about everything. Like, you're going to get the things that you need at discounted prices. It feels like it all kind of tracks into the same story here.
I think we will know when the consumer is back on form, when Alex is back buying shoes. I think that's kind of the takeaway that we will take from that particular data series. Let's talk about this data series, though. Dana Peterson, the Conference Board's chief economist, joins us now. Dana, how should we be reading these numbers?
Well, the index overall dipped for a second month in a row, and within that present situation was down, and also expectations continue to signal that consumers expect recession at some point over the next 6 months, and it's been signaling that for several months. So consumers are definitely showing that the economy lost momentum as we are rounding out to the end of this year.
What is keeping the consumer cautious right now?
Well, it's really about inflation. Food and energy prices are rising. Indeed, when we looked at the inflation expectations gauge, that ticked up, and that's the highest that we've seen since July. Also, when we asked consumers about the present situation, they gave mixed signals with respect to business conditions and also mixed signals with respect to employment. So that's really important. If business conditions aren't doing well, then they start to fear for their jobs. And certainly when we look at the expectations gauges for income, business conditions, and employment, all of them dipped in the month.
Dana, how good is the consumer at picking a recession?
Well, I mean, it's not the case that you can necessarily map it against GDP, but certainly it is a very important forward-looking indicator because certainly the consumption is roughly 75% of GDP. And so if consumers lose hope and they stop spending, then you're probably going to see a recession in the U.S. economy.
Do we get a sense of what kind of recession everyone's sort of expecting at this moment in terms of their expectations?
Sure. Well, our own expectations are that the recession is brief, maybe 3 quarters, and it's pretty shallow. And indeed, when we ask CEOs what they think, they've been saying since May that they think that, yes, there is going to be a recession, either starting the end of this year, we're almost at the end now, but certainly next year, but that it's going to be brief. It's not going to be too bad. And indeed, they're still thinking about hiring, even though they're facing down a recession.
What do you think the Fed should be looking at, therefore, within these numbers, Dana, to get a clue as to what is going on? The overriding narrative continues to be that employment is holding up. You see it in the claims data, you see it in your data. I'd be interested to know what your take is going to be for Friday's number. What should the Fed take away from the series, though, that you've just presented?
Sure. I think the Fed should take away the fact that consumers are definitely feeling the pinch. When we ask them about their buying plans, plans for buying big ticket items like cars and furniture and homes, all things that you tend to finance are ebbing, and that's because interest rates are rising. And so in that sense, yes, demand is cooling, and that the Fed should be pleased that that's happening, because cooler demand will help bring down inflation, which we all know is quite elevated.
So, Dana, then what kind of reluctance or sentiment do they not like?
Well, I think that, certainly if inflation expectations continue to rise, and in the case of our indicator, at least 1 year ahead, it did, that's not good. And the Fed is really trying to address not only the level of inflation, which is high, but also inflation expectations, making sure that they don't become unanchored either over the next year or even over the next few years. And so that's why the Fed is engaging its very aggressive tightening to make sure that they don't have inflation expectations rise out of control.
They are, though, focusing very much on the employment picture right now. It does seem to be one of the key metrics that they are setting policy by. Dana, are you surprised how strong the labor market continues to be?
Actually, I'm not. When we look at the labor market, we're still facing considerable shortages, right? You have entire industries like in-person services, hotels and restaurants are included in that, as well as healthcare, but also manufacturing and trade and transportation. The common denominator for all those industries is that you have to show up to work, and hence you're seeing labor shortages be the most extreme there. And so those industries are still hiring, and indeed labor shortages are probably going to keep many businesses from laying off their workers en masse, because they're going to hoard workers. They spent a lot of time and energy and money trying to attract and keep labor. You probably don't want to undo all of that great work if you think the recession is going to be brief and it's not going to be that deep.
Yeah, I guess just not if you work in tech. That feels like a whole different beast. Dana, thanks a lot. Dan Peterson of the Conference Board, Chief Economist. Thank you very much. All right, coming up, you got the Federal Reserve officials doubling down on higher rates for longer. The data continues to back that up. The market's pushing back, though, against the hawks. We're going to break that down with David Kostin of Goldman Sachs next. This is Bloomberg.
They're counting the first 250 basis points as if that was a tightening of monetary policy, but really that's just getting up to the long-run neutral level of the policy rate. We've only recently moved into restrictive territory, and we're going to have to move farther in order to keep inflation under control.
Further tightening of monetary policy should help restore balance between demand and supply and bring inflation back to 2% over the next few years. It will take some time, but I'm fully confident that we'll return to a sustained period of price development.
You just heard from St. Louis Fed President Jim Bullard and New York Fed President Don Williams joining other Federal Reserve policymakers and really stressing higher rates for longer. And that takes us to the question of the day is, why is the market ignoring the Fed? Joining us to discuss, Goldman Sachs Chief U.S. Equity Strategist David Kostin. David, I appreciate it's hard to make a trend of something when we're nearing the end of the year, but yeah, rates are higher, but the dollar's weaker. Equities are not really responding to this hawkish talk that you might have thought. Why do you think that that is?
Well, I think it will happen as we look into the first quarter, and expectations S&P 500, for example, will be falling to around 3,600 in the first quarter, and you'll see that perhaps rise later in the year to back to around 4,000, which would put you at a flat market, Alex. So your question about, well, what has the market been avoiding? There's this expectation, optimism, if you will, of a potential pivot, and perhaps the Fed may stop hiking rates sooner than we expect here at Goldman Sachs. We're expecting a 50 basis point hike next week, followed by 3 25 basis point hikes in the early part of next year, February, March, and May. And so that's the risk, as I would see it, in terms of the valuation to the market, as well as earnings, negative earnings revisions. I think that is the setup for the entering the new year. I think there's going to be a challenging environment, negative earnings revisions, and a reassessment of the level of rates. Right now, the equity market is at the 80th percentile versus history on an absolute valuation basis and on a interest rate adjusted or relative valuation basis. So it's very expensive, and the risk is, again, that rates are higher than people anticipate.
You talk about relative to rates. Let's talk about relative to liquidity. David, good morning. It's Guy. We're watching the QT story start to unfold. Morgan Stanley had an interesting note out earlier on talking about this being the elephant in the room. When you think about the liquidity tightening that we're going to see over the next 6 to 12 months, how should we factor that in? I can understand how we think about the market versus rates. How should we think about the market versus liquidity?
Well, I can think about it, at least the way I think about it would be in terms of sources of supply and demand for equities. We can think of the largest source of demand historically, consistently for the past 10 years has been corporate repurchases, and that is expected to be very robust next year, although probably 10% lower in absolute levels, probably $900 billion compared next year, compared with around $1 trillion of corporate repurchases this year. So that's one source of modest reduction in demand. Again, that's on a baseline assumption of a soft landing of the economy. In terms of the other sources of demand, which I think I believe a good way to think about liquidity, where's the demand coming from? It's likely to be outflows in the case of households, likely to be net sellers in the coming year. You're likely to see pension funds, historically speaking, have been counter-cyclical, and as other sources of demand have been ebbing or likely to ebb in the future, historically speaking, that's when pension funds tend to step in looking for opportunity sets. So I think those are the sources of supply and demand that I would think about and focus on in terms of the demand for equities.
Hey, David,
that's how I think about it.
David, the calls for 2023 are coming out. Bank of America had theirs yesterday. A pretty wide band, though, between the bulls and the bears, 4,600 to 3,000 for the bull and the bear. What's your strongest conviction for next year, and how much conviction do you have about your conviction?
The strongest area, Alex, in terms of the area of vulnerability would be on earnings. Earnings are likely to be flat. Why is that the case? Well, the economy is likely to keep growing, in our view, and on a nominal basis, given where inflation is, that is helpful to revenues. However, margins are likely to come lower. Why do we have this view? Well, for the first time since the pandemic, margins inflected lower in the third quarter. So we have now the arguably canary in the coal mine. We've just seen this piece of evidence, and when we look out into the coming year, margins are likely to come lower. Well, why have they been rising to the high level that they are? Well, it has been a reduction in SG&A costs, selling, general, and administrative expenses. That has diminished to around 13% of sales. That is much lower than it has been over the long term, maybe 14.5%. That has been a basically a transfer of higher margins overall to investors, net margins. And so therefore, that's the vulnerability, that you have a normalizations of SG&A ratio and those costs. That's likely to keep your margins moving in the downward direction, and that ultimately is the source of why you get no earnings growth. Without earnings growth, therefore, you're dependent entirely on the valuation of the market to move it higher. So, Alice, I think it's a source of debate in the market about where margins will be, number one, and then what's the appropriate valuation in terms of a multiple. The market went from 21 times to 15. It's rallied to 17 times. The vulnerability to that is to the downside.
David, is the scenario you're painting a mild recessionary scenario, or is it something a little bit worse than that? Because the consensus seems to be that we're going to get a mild recession. Is that your view too?
No. The assumption, Guy, we're assuming that we're making is that we have a soft landing, which is to say the U.S. economy continues to grow on average around 1% next year, so modestly. In that scenario, you have no earnings growth. That's an optimistic scenario, if you will, and you have stable kind of evaluation. The scenario in a hard landing that you posit, what would happen in the event of a recession? Well, historically speaking, earnings fall during a recession by around 13%. We have a scenario, when we look at some inputs, that would lead to earnings falling by around 11%. So put some numbers around that. That's like $200 of earnings per share next year. Our baseline is $224, 224. $200 and a 14 multiple, but as you look forward, that would put the S&P 500 guy around 3,150. So think about that as your downside, maybe 20% lower. Again, that's a scenario, not a baseline, but a scenario as opposed to a market falling maybe 10% to 3,600 before ultimately rallying back to 4,000. So I think that's the way we think about it, the way I think about it. Again, baseline assumption is a soft landing, not a hard landing or recession.
So, David, before I let you go, then, where does that leave small caps? A lot of strategists seem to like it going into next year. If your base case is a soft landing, what do you do with the small cap index?
Well, the preference that I would have would be for larger cap. Larger cap companies have more levers to pull to maintain their margins. That's number one. Number two is balance sheet strength. Larger cap companies tend to have stronger balance sheets. Rates are moving higher. Broadly speaking, individual and corporate balance sheets, broadly speaking, are strong, but on a relative basis, they're stronger in the larger cap companies. So I think those are the two areas. Balance sheet risk and margins would be areas that would lead us to a preference for larger cap companies as opposed to smaller cap companies.
David, great to catch up. Thank you very much indeed. David Kostin, Goldman Sachs, Chief U.S. Equity Strategist. Thank you very much indeed. Still ahead, he fired Twitter employees. He tinkered with key features. He restored banned accounts. Now, Elon Musk is picking a fight with Apple. How risky is that? Details to follow. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. The U.S. housing market pulled back even more in September. Prices in 20 large cities fell 1.2% from the previous month, the third straight decline. That's according to the S&P CoreLogic Case-Shiller Index. Mortgage rates have more than doubled this year, slowing demand. HSBC has agreed to sell its Canadian unit to Royal Bank of Canada. The price, $10 billion in cash. The deal will allow RBC to expand its roster of business clients and bulk up its retail presence on the West Coast. The transaction represents a rare domestic acquisition for one of Canada's big banks. And a surprise departure at AMC Networks, known for series such as The Walking Dead. CEO Christina Spade has stepped down after less than 3 months in the job. No reason was given for her departure. The company's board says it's coming up with a replacement. AMC shares have fallen some 40% this year. And that is your latest business flash. Alex.
All right, thanks so much, Ritika. All right, time now for the Red Eye, where we run through the top tech stories making waves from the Bay Area around the globe. And we want to get the view from the Valley and bring in Bloomberg Technology co-anchor Ed Ludlow from San Francisco. Ed, one of the top stories is Musk taking on Apple. Why? How? What's the logic behind this?
Yeah, there are several grievances that Musk outlined with Apple on Twitter, unsurprisingly, in the last 24 hours. The first is the revelation from Musk that the ads by Apple have been pared back. If you go on Twitter right now, onto Apple's account, it has more than 8 million followers. It follows 0 people, but you'll see its timeline is completely blank. And Twitter has always been a mechanism for Apple that it advertises on. It pays to have ads placed in the timeline. It just doesn't tweet of its own volition. And what we're hearing from sources is indeed Apple has pared it back. The situation is a really interesting one because according to sources, Apple was spending more than $100 million a year placing ads on the platform. For Apple, it's a really key mechanism. Apple does not use Facebook for ads, for example. So that's the first grievance. The other one, the accusation leveled by Musk at Apple and its CEO Tim Cook, is that Apple hates free speech. Which is an inference or conclusion Musk has drawn based on the idea they're paring back their activity on the Twitter platform.
Ed, if you were to walk around San Francisco and talk to people that work in tech, would they agree or disagree with Elon Musk when it comes to this story surrounding Apple?
I think this is a really interesting one because we reported on the layoffs at Twitter, but we also reported that a lot of engineers left of their own volition. And yeah, we speak to lots of people around San Francisco, out in the broader Silicon Valley area who are on the engineering side, and they don't agree necessarily with the platform changes that Musk's making. Apple's instance is really specific because it's a very top-tier advertiser. You know, sources were telling us that until very recently, a whole Twitter team was dedicated to Apple. And you acknowledge that this change from ad-based model to subscription model doesn't happen overnight. So why alienate one of your biggest advertisers? Why go after and start a fight with one of the biggest publicly traded tech company in the world?
Because Ed, they charge 30%. And this was the issue that Epic had. This is an issue that lots of people have with Apple, that they take 30%. And a lot of people don't agree with that. So that's kind of where I'm coming from here. Do people agree that actually picking a fight with Apple is the correct thing to do because they're overcharging? They don't deserve this 30%.
Yeah, and Musk's opposition of the 30% is not new, right? He's tweeted about it in the past, the famous meme, turn in the road highway, where you pay the 30% or you go to war, and Musk said he would choose to go to war. I think what's really interesting is Twitter's fate vis-a-vis the App Store, right? So Musk said that Apple would consider taking Twitter off the App Store without explaining why. When you think about Twitter's business model and wanting to charge $8 a month for the verification or subscription service, actually there is a mechanism for them to do that without the App Store. They just do it online. The difficulty, and you can read about this on our story on the Bloomberg Terminal, is what if they start advertising on the Twitter platform the idea that you can circumvent the App Store rules by doing this? It's then that they might have an issue and they'd encounter this kind of argument about Apple's monopolistic practices, which of course are also being debated in court as we speak.
And where does this debate go now? I mean, I feel like we're going to have to get used to Musk using Twitter as a platform to attack companies that he has problems with. How does Apple then respond to this in an official capacity?
Yeah, I think it's really interesting. One of the key points, right, is that he is doubling down on the idea that freedom of speech is an essential right and that Twitter is going to be a place where freedom of speech is protected. But right now, some of the biggest concerns are over moderation. You know, this goes back to the layoffs issue we were talking about. Who right now is enforcing policy? If you go on Twitter's website right now, the other piece of news is that the COVID-19 misinformation policies were suspended as of today. So the question that a lot of people here in San Francisco, broadly around the world, have is who's policing any of this? Who holds Elon Musk to account on the Twitter platform?
Yep.
He talked about this oversight council, but that seems now to be on the back burner.
And that's where the EU definitely has a major problem with what is happening here as well. Regulators are certainly paying attention. Ed, great stuff as ever. Bloomberg Technology co-anchor Ed Ludlow joining us from San Francisco for the West Coast Wake Up. Coming up, our next guest.
No. We're debating titles right now is what's happening.
So yeah, basically. And we're doing it on air. We're seeing what works. China's healthcare system could be good. I can't speak now.
We're about an hour into the U.S. trading session. Abigail tracking those moves. We are a bit higher, and I keep forgetting that tomorrow's month end, too.
Yeah, it's pretty amazing, actually. This has been the month that has just snuck by. But right now, we have very small moves. And what really catches my eye in the month, the NASDAQ Golden Dragon Index, its best month ever, up 31%. Today's 6.5% gain, a piece of that. But relative to U.S. equities, a little bit of a gain to Alex's point on anemic volume once again, more than 30% below the 20-day average. Oil up 2% 2.6% in China on the possibility that there is going to be a reopening there after yesterday's fear. Now, today we have yields up a little bit, not holding back stocks all that much. And of course, a big piece of this pop, well, actually now coming back in for the 10-year yield. But Amazon has announced its second big bond deal of the year, a 5-part bond deal. But there's a very interesting article out on the Bloomberg Terminal today, Bond Blitz. There could be 10 IG bond deals today, so some competition for yields. Now, if we speak about competition between yields and stocks, the big one, of course, it is the terminal rate relative to the S&P 500. This is an inverted terminal rate in blue. If it was going the right way, it would be higher. So that story of yields up, stocks down. But the interesting point right here is you have the terminal rate basically going higher, but stocks more recently have been going higher. So investors are getting a little bit more comfortable with the idea that the Fed is raising rates. The question, of course, will be that pace. We'll be getting more detail on that tomorrow from Fed Chair Jay Powell, and of course, in a couple of weeks at that FOMC meeting. And then here's a little bit of a breakdown, more of a breakdown, I should say, on the China tech rally. I mean, this is really incredible, guy. Take a look at JD.com, up 9%. Bilibili up an amazing 24%. The online entertainment company following in Pinduoduo footsteps yesterday. Both of those companies put up tremendous quarters, very strong quarters. The outlook, I guess, for Bilibili, not great, but you wouldn't know it taking a look at these stocks. I think it's a little bit of that catch-up thing where investors don't want to miss out, given the fact that if you took a look at these stocks on the long term, they're all down more than 50% over the last roughly 2 years or so.
Abigail, thank you very much indeed. Abigail Doolittle, thank you very much. Let's talk about China. The big story yesterday, having an impact on oil today, I think. The reopening story is going to be a big struggle for this country. Airfinity, which has been crunching data throughout the pandemic, is now warning that China's policies have left the country with little or no natural immunity. This is a huge problem, particularly for the elderly population. Joining us now with the details on the latest report is Rasmus Bech Hansen, Airfinity's co-founder and CEO. As I said, you guys do data. You've been tracking this throughout. We've come to you every time to figure out what is happening. Rasmus, just talk to me what the picture looks like right now in terms of natural and acquired immunity in China. If it was to open now, how exposed would the population be?
Yeah, China is facing a very, very difficult situation. I would say it's almost as difficult as it was 3 years ago when COVID just hit for a number of reasons. The protection levels overall, when you model the number of the vaccine uptake, the vaccines they've taken that use the homegrown vaccines that are less effective than the Western vaccines, and then also take into account that this strain of the variant, the Omicron, is significantly more transmissible. And to a naive population as the Chinese that hasn't been exposed to the virus, it is as deadly or deadlier than the original strain. When you take all of that into account, model it, also look at what happened in Hong Kong. Hong Kong is quite a good proxy for what would probably happen in China. Then what we're seeing is that up to 2 million people could die in the coming 6 months if COVID runs wild. So a full opening of China, in my view, seems like a very risky endeavor and maybe not very likely.
That's a huge amount. I mean, 2 million deaths. Obviously, China is trying to find a middle ground. Can you walk me through the models of vaccination for the elderly, like how quickly China can do that and how quickly there can be some kind of immunity? And does it change based on the vaccine that they choose?
Yeah, so I think the way forward for China would really be to model the Western playbook, which is buy yourself time to get vaccination uptake. Really what's quite remarkable now in China is vaccination has almost stopped. You know, there's been very little vaccine uptake over basically since the spring, which means that even the vaccine protection is quite low. And then taking into account that the vaccines were 20 to 30% less effective against hospitalization and death than the Western vaccines, that gives you these picture. I would say that it's important to bear in mind that the case rates in China are still relatively low. They're lower than they are in most European countries, lower than they are in the US, and if you look at South Korea and others, they're much higher, right? So the cases, it's small enough that China can contain what they have now, and then they can boost with a vaccination campaign. I think the part of the problem is that maybe the Chinese population is skeptical of these vaccines, because even the high-risk groups have fairly low vaccine uptake rates, which is different from what we see in the West. So I think importing Western vaccines is one of the obvious way forward for China. And they could do that gradually while still track and trace, keep the infection under control to confined areas, and then buy themselves time to get more of the population vaccinated, and then gradually also acquire immunity, natural immunity, as we've done in the West.
Rasmus, if we were to see China reopening, if we were to see case counts balloon, how big a risk would there be that we would see a new variant emerge from that group that would pose a threat to the rest of the world?
Well, we're seeing new variants all the time. I think that would be part of the threat, but really the bigger threat is to the Chinese people. You would see overflown hospital, Chinese hospital. If you look at spare capacity of ICU, spare capacity of hospitalization, there isn't a lot already in China. If you see what happened in Hong Kong, it was a very dire situation Hong Kong was facing. I think that's what you're going to see, and I think it's unlikely that the Chinese authorities will be able to accept that.
Right, which is why it feels like at least getting the elderly population, which is exactly where the West was at, a year and a half ago, 2 years ago.
Yeah.
So Rasmus, to that point, how many shots would the elderly have to have for that to ease the pressure on ICU and ventilators?
Well, if you just got one shot of good vaccine, you would go really far. Ideally, you would have a double shot, but just one shot of a good vaccine there. We modeled how many vaccines are available in spare vaccine stockpiles of Moderna, Pfizer, and other Western vaccines. So there are more than 1 billion available. So the vaccines are actually out there. Omicron-produced vaccines are now in the number of like 150 million a month that Pfizer and Moderna are producing of those. So those could also be shipped to China. So I think, we're seeing that actually the shortage of vaccines that we saw early on in the pandemic, that's not the situation. The vaccines are there, they're available, they could be shipped to China, they could be applied. And then also I would mention that therapeutics, we have now, part of the reason we're seeing lower mortality rates in the West is also because we have better treatments. We have very effective treatments. And China could also buy more of those and start applying that. That could also ease the pressure.
Is what you're saying basically that unless China decides to buy huge quantities of vaccines and therapeutics from Western pharmaceutical companies, there is no obvious and easy way out for it? Are you suggesting that really is the only route that they have open to them?
I don't think they could use their own vaccines. That would be better than nothing. But you got to ask yourself, why is it that the vaccine uptake in China stopped in the spring, right? Why was that, right? Probably one big reason is that there was the population was unwilling to take it, right? So it would be better to use Western vaccines. Second best, use their own vaccines. But this kind of constant lockdown with no end in sight, it's not like China can protect itself from the virus forever, right? They will have to have the virus living in the population at one point. There's no other way. No country, not even China, can protect themselves against this virus. It's impossible.
Okay, so to that point, you mentioned the staggering number of 2 million deaths. It was just like a broad reopening. What kind of deaths and hospitalizations can you guys model if we do see an uptake of vaccine? Like, where is the tipping point? Like, if you get 70% of the elderly population vaccinated, does that death rate come down?
Yeah, definitely. So it would all depend on the uptake, and especially uptake of the vulnerable population, and then also the treatments, the type of treatment. So that would be difficult to put a precise number, but I think it would be significantly less. It's unlikely that China will have no deaths. It'll probably be more, hundreds of thousands no matter what. But the 2 million, that would be like a third to a fourth of the total deaths of COVID worldwide. So that would be very, very much. I think they could bring in much less than that. 10% of that or so would, or maybe even less. But it depends on a lot of factors.
All right, Rasmus, we'd love to catch up with you. It's been way too long. Rasmus Beck-Hansen, Airfinity co-founder and CEO. Thank you so very much. Just some breaking news for you here. The BOE sells a total of 346 million pounds of debt. This is the first in their sale of emergency holdings. Remember, the BOE had to step in and help backstop the gilt market when there was such drama caused by Kwasi Kwarteng and Liz Truss's mini fiscal budget. They are trying to get rid of this now in a way that's not going to hurt or affect the market. So they sold about 346 million pounds of that debt. We will talk more about this within the next hour. Coming up right now, we're going to be speaking with Arnold Donald, the vice chairman of the world's biggest cruise operator, charting a course out of the pandemic. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. President Biden and House Speaker Nancy Pelosi are moving to prevent a strike that would shut down the nation's freight railroads. The House is preparing to take up legislation to impose a labor settlement despite the objections of some unions. A rail strike could hurt the economy by crippling supply chains. NATO is discussing how to improve Ukraine's defenses against Russia over the winter. Speaking in Romania, the alliance's Secretary General vowed that NATO will stand for Ukraine as long as it takes.
This is a critical time for our security, and we are sending an important message. NATO is here, NATO is vigilant, and NATO is ready to defend every inch of Allied territory.
Stoltenberg also said the war has demonstrated what he called the dangerous dependence on Russian gas. China plans to increase COVID vaccinations amongst its senior citizens. It is a step that health experts regard as crucial to reopening an economy stuck in harsh COVID-0 restrictions. Still, Beijing stopped short of announcing mandates that helped raise inoculation rates in other countries. The move comes after a weekend of protests demanding an end to COVID limits. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
All right, Ritika, thank you so very much. All right, so Thanksgiving weekend is done. Now we're all looking ahead for the Christmas holidays. Now, travel executives are relatively optimistic about what is ahead of the industry. At a conference, many spoke to Bloomberg about what they look at for 2023.
We're coming into this year with a record bounce back. It's a £1 billion bounce back that we did, and we achieved also the highest earnings ever in the last quarter in the company's history. So what we're seeing now for this winter going forward is that the peak periods are doing really well.
What's happening is business travel on a global basis is coming back very rapidly, and meetings and events is coming back as well, and there's a massive amount of pent-up demand for both of those categories of travel.
With what's happening in the world, with inflation, with maybe recession, thank God we had a good 2022. I think we're going to have a good first semester 2023, and then the odds are I don't know. But I'm a true optimist, so it should be carrying on as long as people have the wherewithal to travel and money to spend on leisure.
That was a great answer. First half, sure. Rest, I don't know. Well, the cruise industry was one of the hardest hit by that pandemic. All their ships are back in the water, and Carnival is hoping to return to pre-pandemic levels in 2023. Now, joining us from Riyadh at the World Travel and Tourism Global Summit is Arnold Donald, Carnival Vice Chairman. Arnold, it's good to see you. So I think the Accor CEO said it best. First half of next year is going to be fine. Then after that, I got no idea. We're dealing with recession risk and high inflation. What's your outlook?
As chair of WTTC, I'm happy to be here in Riyadh at our global summit. It's spectacular. The energy is high, as you saw from those you interviewed, because as we look ahead, things look pretty promising, frankly. And the only thing I think that can slow down the growth in travel and tourism is people not being able to travel or people being afraid to travel. I think if there's any issue in terms of go forward on people traveling in the future because of recession and that sort of thing, there will probably be a reallocation. In other words, they may change their specific plans, but I think they're still going to travel. People have a pent-up demand to travel and an intrinsic desire to do it.
Arnold, good morning. It's Guy, or should I say good evening there in Riyadh. Do you think they're going to be spending less, though?
Yeah, hi. I think it depends. We don't know. We have to see to what extent the recession occurs and how deep it is. People may choose to spend the same, may set a budget and say, I can't spend any more than that. But clearly, depending on how severe it is and what location it happens and how even it is across the globe, of course, it can ultimately impact spending if people get really nervous about their financial futures. In the case of cruise, we've learned that during recessions, we're not recession-proof, but our industry is recession resilient. People choose to cruise because it's a great experience, but it's also, from an economic value standpoint, a better value than you could in a land-based vacation. So we don't see big impacts from recessions in cruise, but some other forms of travel and leisure might.
Arnold, I wonder, though, if the patterns change in that when we talk to airline executives, they say, oh, well, we're seeing people who are worried about money go to tier B cities or go to smaller destinations so they don't have to travel that long. Are the patterns changing out of the pandemic and into a recession?
So far, in terms of out of the pandemic and into a recession, I would say this. The patterns would certainly change if there was a deep recession that was consistent around the globe. Patterns would definitely change. Patterns have changed coming out of the pandemic, not so much in terms of closer in and all that, but coming out of the pandemic, they've changed because people have a pent-up demand for travel and experience. And so you've seen a big boom. Some of it is probably because some people had stimulus money tucked away, but a lot of it is just because they weren't able to for so long.
Let's talk about what you're spending within this industry. Arnold, can you get the people that you want? Are you having to continue to pay more? What's happening on the cost that you're having to get from your suppliers? Do you think inflation is anywhere near peaking?
There is obviously inflation on many items. In terms of generating demand, I wouldn't say that it costs more to get the demand today. We've got new approaches to generate demand. Media mix, for example, and advertising stuff has changed. We've moved more to paying for people who actually book versus just general reach and that sort of thing. So there are ways you can manage your costs, be more effective, be more productive. And so in that regard, in terms of accessing guests, I wouldn't say the costs have gone up dramatically. In terms of servicing those guests, then of course, food prices in many places have gone up substantially. Obviously, fuel prices have gone up. They're starting to come back down. But these things all happen over time, and obviously we're taking a longer-term view of all of this and not just the immediate near future. But in the coming years, we see tremendous growth. Here at the summit, we shared information real quickly that while the GDP growth is anticipated to be around 2.8% or something like that, will be over 5% in travel and tourism broadly. I'm talking all of travel and tourism now, growth.
Arnold, talking about costs, I wonder how you look at the labor situation. So first of all, do you have enough staff, and how hard is it to hire? And second of all, if we do get a recession, how sticky would those jobs be? We keep hearing about, say, industries and companies that had a hard time hiring back after the pandemic won't necessarily fire workers in a recession because they're worried about getting them back. Can you tell me how you understand this in your industry?
Yeah, within the cruise industry, basically what happened is we, in our company alone, will hire 20 to 30,000 people every year. And so we do it from over 145 countries. But it's a pipeline, and that pipeline gets filled by agencies that do some preliminary training and whatnot for us. So when the crew comes, they're partially trained, and then we finish it when they come into our company. So that pipeline emptied during the pause. So we paused operations for an extended period of time, and all of that shut down. So with that, we had to refill that pipeline. So there was a period of time when it was very challenging. Also, there were visa issues, in the beginning because of the different health protocols and what have you. Those have reduced. The pipeline is filling up again, and I don't see it being a crisis to be able to get talent. But again, we recruit from 145 different countries, and so over time we should be in really good shape in that regard.
Arnold Donald, sir, thank you very much indeed for your time. We really appreciate you joining us from Riyadh. Arnold Donald, Carnival Vice Chair. This is Bloomberg. So let's take a look at where we are as we come towards the end of the day here in Europe. Stock's doing nothing, to be honest. At a headline level, we're barely budging. We're up by around 0.2%. I think the action is elsewhere. Brent crude rallying. We're up by 1.85%. That appears to be on the back of the idea that China is going to vaccinate more people, which potentially could mean that lockdowns get eased. But as we've just been hearing from Airfinity, that's going to be a tricky line to walk. The German 10-year, I think, is interesting today. The yields are generally lower, Alex, here in Europe. The Spanish data was a little softer. The German data was a little softer as well. But actually, if you look through the details, I didn't think it was that soft, and it's still relatively elevated. The debate is around 50 or 75, and it's a similar conversation that we're having here in the UK as well. It's interesting. Catherine Mann's been talking about embedded inflation, kind of sticky inflation around 4%. You've got Andrew Bailey currently giving testimony to the Lords as well, just talking about the fact that the gilt market just remains broken, and this whole issue of the labour market is really problematic for the Bank of England, Alex. It's really embedded here, this problem that we're having with this tight labour market.
Yep, and that's not something that the BOE can solve at all, because part of that's going to have to do with immigration as well as Brexit. But what is also interesting about this whole conversation is that even if you say have overall inflation lowered, underlying inflation can get much stickier. That's unrelated to, say, fuel prices or natural gas prices. And that's, I think, what the problem is. We didn't get that level of granularity today for Europe, but maybe we'll get that tomorrow.
Absolutely. The message, though, from the ECB and the Bank of England, though, is, I think, on balance, slightly more hawkish than maybe the market has got priced. Anyway, we're going to talk about European banks. We're going to talk about what's happening in banking more broadly. Leon Calvaria, chairman of Citi's Institutional Clients Group, is going to be joining us in the next hour. Really looking forward to this. This is Bloomberg. Tuesday, the 29th of November, European equities broadly bid, but fading into the close. You've got miners doing well today. The banks just continue to do well. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So, Stock 600 up by around 0.2%. London outperforms a little bit. The miners are the reason for that, doing a little bit better today. Commodities generally broadly up on the back of maybe more positive China news. Maybe a little early to say on that front. You're also seeing the banks continuing to perform. We'll talk about HSBC. We'll talk about why banks are continuing to perform here in Europe, outperform in many ways in the second hour of the program. Euro dollar up a little bit today. The inflation data we've seen from Spain and from Germany starting maybe to roll over a little bit. Was today's data consistent with 75 basis points from the ECB next time round, or for 50? I think it probably looks like the latter. And some single stocks. There are a number to choose from today. I've gone with the football theme. Juventus down by 0.9%. It was off significantly earlier. Again, we'll talk about this. We're going to take you to Milan to talk about what's happening with Juve. The Agnellis, are they looking for an exit? We will find out, I suspect, over the next few weeks, Alex.
Yeah, same with football. 3 hours, and then you got that U.S.-Iran match. Okay, here in the U.S., S&P is up by 0.1%, but I have to say volume is still really light. Tomorrow is the last day of November as we head into the end of the year, so it's hard to take a lot of signal from what we're seeing. The dollar a little bit softer, peculiar, because the Fed hawk language is out there, higher rates for longer. The 210 spread, which is what everyone's now watching, how much can it invert? How long can it stay inverted for? We're now at 73 basis points, well off that deeper inversion that we saw from yesterday. And the VIX is interesting. We're at under 22, but some DeMark indicators, he's that same technical analyst, are saying that maybe we could see a reversal of the VIX and what that would wind up meaning for the rest of the market. And on the eco data front, it's kind of steady as she goes, like softer data. We know that's happening. Then how does the Fed interpret it and take that as we head into Jobs Friday, Guy?
Yep, the data. Do you follow what the Fed says? Do you follow what the ECB says? Do you follow what the data are telling you about what is happening with these relevant economies? They were starting to get an early glimpse of what is happening with the European inflation picture. The ECB is going to be paying a great deal of attention to these numbers. We've had numbers out today from Germany and from Spain. We're going to get the rest of these numbers throughout the week. We're going to build up to the Eurozone data later on in the week. Both numbers softening up a little bit, but still relatively elevated, I think, certainly by historical standards. Germany dipping from 11.6, these are headline numbers, to 11.3. Spain, 7.3 to 6.6. But the core number also is critical here, and it remains elevated. And I think that's going to be an ongoing and consistent problem for the ECB. Alex, you heard what Lagarde had to say yesterday. She sounded hawkish. Isabel Schnabel also sounding hawkish as well.
Yeah, what I found really interesting, if I just dig into Germany for a second, and this goes back to shopping, no surprise, package holiday prices fell about 25% on a year-on-year basis. And I'm curious, is that like high comps? Is that a supply issue, or is that a demand issue? Like, are we seeing the pandemic supply issues ease, in which case that could fall even further, or is that a demand signal, which would be much more negative for the European, for the German economy?
Well, you think about what's happening with the German consumer at the moment. They are certainly under significant pressure. Gas prices are rising. Energy costs are rising as well. Food prices are certainly incredibly elevated. It's really hard to tease apart what is happening here, because the broader picture is, and we're seeing on both sides of the Atlantic, the consumer in so many ways is actually still in fairly robust form, which is really interesting. The other thing that we've got to think about here as well is, does raising rates solve the problem? I know that the ECB is worried about second round effects, and I know we're starting to see some evidence of that. But at the moment, this remains an energy shock in so many ways. Does raising rates actually solve that problem? Christine Lagarde, as I mentioned, saying that actually and talking about this, inflation hasn't peaked yet. Is she right? And what about this whole kind of question about whether or not raising rates is going to reduce inflation at this point, given that this is, in many ways, a terms of trade shock? Here's what Irene Tingali, an Italian economist and also European Parliament's Economic and Monetary Affairs Committee chair, had to say on that very subject a little earlier.
Well, the problem with inflation in the euro area compared, for instance, with the inflation in the United States is that we have, on one hand, a peculiar kind of inflation, which is mostly driven by energy prices that both directly and indirectly affect the inflation rates. And this is something that, unfortunately, cannot be changed easily by just hiking the interest rates.
Yet, if you've only got a hammer, maybe every problem looks like a nail. Jamie Rush, Bloomberg Economics Chief European Economist, joining us now. Jamie, let's start off and talk a bit about the data. Is that data consistent with the idea that the ECB at the beginning of next month should be going 75 basis points or 50 basis points? Can they downshift like the Fed is hinting at as well?
I think there's a feeling on the Governing Council of the ECB that there isn't actually consensus for a 75 basis point hike unless there is a surprise. Yeah. And, the ECB doesn't like surprises. We don't like economists not being able to explain why inflation is higher than they thought. That is bad news, right? So, I think the data at the moment, what we've seen from Spain and from Germany, are pointing the other direction. It looks like energy costs are falling a bit faster than anticipated, and maybe we'll actually get a downside surprise, the first for a while, on inflation, and that will allow the ECB...
Is that what you think is going to happen?
I think that's what our forecast is. We have a below consensus call for.
Well, Jimmy, can inflation then keep falling with the same kind of speed? Or does inflation then fall like we're seeing and then it kind of just stays there? Because that, in essence, will also determine a 50 or 75 bips.
Inflation is going to fall at a similar sort of speed. It's going to keep falling through 2023 as we see those energy costs disappearing from the annual comparison. But this is the moment, of course, at which the ECB is going to switch from focusing on headline inflation to focusing on core inflation. And we've already started to get a flavour of that. And the question is, how sticky is core inflation going to be? And our analysis says that we're going to see that it's kind of plateauing until the end of the first quarter. And that's when we think there might be a possibility that the ECB actually brings the hiking cycle to an end.
Given the fact that wage rounds are happening now, is this the moment for the ECB in any way to turn dovish? The message, given the fact that wage negotiations are happening right at the moment, presumably still needs to be relatively hawkish.
I think that's a justifiable position because we don't know exactly how these wage setting processes happen. And if the ECB is saying, "Oh, we can I can see a position." I think what's crucial this pay round is how much of it's like one-off pay support relative to
bonuses, etc.
Relative to things that last for the rest of eternity. That's what I think that we're going to be looking at over the coming 6 months. So far, we've seen a lot of those one-off bonuses.
Hey, Jamie, what's your forecast for the terminal rate, and then how long the ECB stays there? Whether or not we get 50 to 75 in December, it doesn't really answer the longer-term issue or question. What do you guys look at your forecast as?
We think the refi rate will get to about 3%. Deposit rate a little bit lower than that. The question is, what is it going to take for the ECB to start heading back towards the neutral rate? And for us, we don't see any obvious evidence yet that that's changed relative to even pre-pandemic. So end of the year, we think inflation is going to be dipping back towards target, maybe even forecast for 24 looking below target. And if that happens, we think that the ECB will start cutting rates at the end of the year back towards neutral, around 1.5 towards 2%.
I just want to switch to talk a little bit about what's happening with the Bank of England. The governor currently giving testimony down in Westminster to a Lords committee. This is what he had to say about the gilt market.
I've seen a number of newspaper articles recently said that, well, if the Bank of England just retained the portfolio for its natural life, there would be no loss, and that's not the case. You're right that if we did a single very big sale, it would bring it forwards. I would, though, caution that, and we've obviously had a period of severe illiquidity in the gilt market. Indeed, it's not back to normal at the moment. But I think doing that would be a very, frankly, inadvisable thing to do.
Jamie, the gilt market's not back to normal, and the UK labour market is not back to normal either. The UK labour market's beginning to feel like a bit of an anomaly. Catherine Mann's been talking about this today. The governor's been talking about this. Brexit has caused all kinds of issues. There are a number of other factors that are making the situation more difficult as well. If the UK labour market remains as tight as it is at the moment, is there any way that the Bank of England can slow down or stop raising rates, given the fact that we don't see the employment situation turning better from an inflationary point of view?
I think the Bank of England is going to need to see unemployment going up before they feel comfortable that there's going to be enough slack in the economy to bring inflation back down. And as you say, the labour market is tight. There's no obvious way that that's going to change unless the economy really starts to slow. Why do we have a tight labour market? Well, a load of people have disappeared from the labour market, and a lot of the reason for that is they're just sick. And these sort of backlogs on the health service that are keeping these people away from work, they're not going to be fixed anytime soon. So that element of tightness is going to stay.
All right, Jamie, really appreciate it. Thank you for helping us break down the analysis here. Jamie Rush, Bloomberg Chief Europe Economist for Bloomberg Economics. All right, coming up, we are awaiting a news conference by NATO Secretary General Jens Stoltenberg. We're going to discuss what to expect there with Fabrice Potier, Rasmussen Global CEO, coming up next. This is Bloomberg.